In this video, we will discuss about very interesting topic, hedge accounting. Hedge accounting is covered under IND AS 109 financial instruments and derivatives. So every business operation of each entity is exposed to different type of financial risk. It may be risk of interest, commodity price risk, or foreign exchange risk. So all these risks affects the profit and loss account of an entity. And ultimately, it's because of the change in the value of the assets or liability or the cash flow that may be increased or decreased because of the defined risk that may be related to interest or commodity price or foreign exchange or any other risk that may ultimately because of valuation or cash flow will affect the profit and loss account of the entity. So hedging is a risk management activity that is undertaken by an entity to manage the risk. It may not be eliminate the risk, but it will manage the risk to keep them in managerial proportion or changes the entity's risk profile according to the intention of the business operator. To understand the hedge accounting, let's take one example. An importer enters into a firm commitment to purchase inventory in a span of 1 year at $100. In this case, the importer has a risk, foreign exchange risk, that its payout may increase because of the change in the exchange rates. So to hedge that foreign exchange rate risk, it enters into a forward contract to buy $100 at a strike rate of 61. If you follow the normal accounting principles, the inventory will be booked at a spot exchange rate prevailing at the time of purchase. It may be 54, it may be 61, it may be 65 or 70, whatever it is. And the forward gain loss, it will be booked immediately in the PL. So there is a difference, mismatch. One thing is booked at the date of purchase, another thing is booked immediately in the P&L account. So this accounting creates significant mismatches in profit and loss account of an entity. So the idea of hedge accounting is to reduce this mismatch. And this hedge accounting is a matter of choice. So it's optional. And choice can be applied transaction by transaction basis based on the qualifying criteria. Relationship between the hedge item and hedge instrument can be categorized in three categories based on the characteristics of each case. It may be classified as a fair value hedge or cash flow hedge or net investment in foreign operations. And for example, in case of fair value hedge, it has an exposure to change in the fair value of the instruments for a recognized assets or liability or unrecognized firm commitments or component of any of these cases. For example, change in the fair value of fixed rate debt instrument that has changed because of change in the interest rate will be classified as a fair value hedge because it is changing the fair value of the underlying instrument. Similarly, firm commitment to buy steel, fuel, copper, etc. will be classified as a fair value hedge because it is related to the change in the fair value of the instrument. Similarly, if exposure is related to the cash flow variability for recognized assets or liability or highly probable focus transactions, it will be classified as a cash flow hedge. For example, interest rate swaps or hedge for future sale of the inventory. Apart from it, IND AS 109 specifically allows fair value or cash flow categorization of hedge for foreign currency risks. Hedging relationships are eligible for hedge accounting only if they meet certain qualifying criteria. For example, it consists eligible hedging instruments and hedged items. And entity at the inception formally designate and document hedging relationship, risk management objective, and the risk management strategy. Entity in its document should include identification of hedging instruments, hedged items, and the risk that is being to be hedged, and how it is going to assess the relationship of all these things. Hedging relationship should meet the effectiveness requirements also. Economic relationship between the hedging instruments and hedged item. Apart from it, the credit risk effect should not dominate the value change that result from the economic changes. The general notion about the hedge accounting is the change in the value of a hedge item and hedging instrument offset the value effect. But because of the credit risk, if the effect is not going to be eradicated, so it will not meet the hedging relationship criteria. And next is there should be similar hedging relationships. Yes, 109 permits to designate hedging relationship prospectively from the date it completes the necessary documentation of hedge relationship. the identification of hedging instruments and hedge items, and documentation in respect of the nature of risk being assessed and how the entity will assess the risk. Designating hedging relationship retrospectively is not allowed. Fair value hedge accounting. Hedging instruments are measured at fair value, and any change in the fair value of hedging instruments is recognized in profit and loss account. There is one exception to this principle, that if any hedging instrument that hedges an equity instruments that is designated by entity on FVT OCI, in that case, change in the value of hedging instrument is to be recognized in OCI instead of profit and loss account. This is because to offset the effect, both the effect in OCI only. Of fair value hedge for hedged item depends how the hedged item is valued. In case of non-financial item, it is uh, valued at amortized cost. In that case, we need to adjust the carrying amount by hedging gain or loss and the corresponding amount to be recognized in profit and loss. In case of debt instrument that is measured at FVT OCI, we need to recognize gain and loss in PL instead of OCI. Similarly, the equity investment that is measured at FBT OCI, we need to recognize the impact in OCI because, as we have learned in the previous slide, the hedging instrument that hedges an equity invest instrument for which an entity has elected to present changes as FBT OCI. So, fair value changes of hedging instruments are also booked in OCI. So, to offset the impact, the gain or loss on the valuation of hedged item is also booked in OCI. Next category is the firm commitment. We need to recognize change in fair value as assets and liability with the corresponding gain or loss to be booked in profit and loss. And on the execution of firm commitment, we need to include the cumulative change in the fair value of asset or liability that is acquired. As accounting, we need to adjust the cash flow hedge reserve with lower of cumulative gain or loss on the hedge instrument and hedge items. So finally, the effective portion will go in OCI and ineffective portion will be recognized in profit and loss account. And such, the accumulated cash flow reserve will be booked as if the forecasted transaction results in recognition of non-financial asset or liability, the portion of reserve will be included in carrying amount of assets and liability. And for the cases where it is not going, forecasted transaction is not going to be results in recognition of non-financial asset and liability, it should be recognized in P&L in the same period during which the hedged expected future cash flow is going to affect the P&L. And for the cases where entity expected the accumulated cash reserve amount, cash flow reserve, hedge reserve is lost, and there is no sign of recovery of that loss, we need to recognize it immediately in profit. Cases of net investment in foreign operations like subsidiary, joint ventures, associate, or branches will be accounted for similar fashion in which cash flow hedge is accounted for. For example, effective portion will go in OCI and ineffective portion will be recognized in profit and loss account. Apart from it, hedging instrument may be held by any entity or entities within the group, and hedge risk must relate to the functional currency of entities involved. And if the same net assets of a foreign operations are hedged by more than one parent entity within the group, only one hedging relationship will qualify for hedge accounting in consolidated financial relationship. So this is all about the summary of hedge accounting. It's a very vast topic that can be discussed in multiple sessions, but this is a summary. And if you have any query or need any clarification, you may contact the WhatsApp number. Thank you very much.